Hello everyone. Today we're going to talk about inflation. As you know, inflation is very high today in the US, but also in Europe. So a good question to ask yourself is which asset should I own during this period? So we're going to talk about this today. First of all, I'm going to define exactly what is inflation, what we're talking about here, and then we're going to go through all the assets which are usually considered as inflation edge, and on each one I will give you my opinion. All right, let's do it. As a reminder, this video is not a financial advice. I'm just giving my opinion here. Before you invest, you must do your own research. Also, if you like my videos, please subscribe, like. This is really helping me to develop this channel. First of all, let me give you some definitions and principles. Inflation can be defined as an increase in asset prices, but it can be many types of assets actually. When you're hearing about inflation in the media, usually they are talking about the CPI. This is the Consumer Price Index. Basically, inside this index, there's all the things and services that you buy every day, like your food, like for example, it can be your electricity, your rent, your clothes. So these type of things. But actually, it's not everything. There's other types of assets, like real estate, for example. There's a big part of real estate which is not in the CPI, and there's also all the financial assets like stocks or bonds. And so actually what we see usually is that the inflation can impact these different types of asset classes, but not at the same time. You see, for example, right now we have a big CPI. It's pretty high. It doesn't seem to go down. And on the contrary, we have the financial assets like stocks or bonds, who are started to decline a lot. I mean, since the beginning of the year. So that's what you need to understand. Inflation can impact all the asset classes, but not at the same time. Secondly, what you need to understand is that when there's inflation, it means that the value of your currency is going down, and therefore your purchasing power is going down. For example, let's take an example. For $100 at the beginning of a period, you can buy $100 of food, and then there's 10% inflation during 12 months. So it means that this same quantity of food at the end of the period is going to cost you 110. Okay, so if you have only $100 and you keep this $100, well, at the end of the period, you won't be able to buy as much food as before. Your purchasing power will go down by 10%. So this is why it's very important when you look at the performance of your portfolio to take account this inflation and to look at only the real return. The real return, it's the difference between the return on your asset minus the inflation. And then you look at this number if you see if really your portfolio has gone up. So now let's take a look at an example of real return. So here we can take a look at this graph. This is the total real return indexes for different types of asset classes. Actually, I have already shown this graph in another video about asset classes. I will put the link now. So you can see here, for example, that for the stocks, you have over time a performance in average of 6.7%. But it's a real performance, meaning that it's the performance of the stocks minus inflation. So basically, it means that even if you take into account the inflation, you have a quite good performance of this asset class, okay, the stocks over time. But if you compare, for example, with gold, for gold, as you can see here, you have, you can compensate the effect of inflation with gold, but not much more than that. Okay, you're not going to have over time a very good performance historically. And then let's take a look at another example of real return. So here we can take a look at the wages. So we are here in the Eurozone. It's a graph from basically the year 1998 until today. So as you can see, until the year 2020, basically all the wages were, fluctuating around zero, sometimes a little bit more, sometimes a little bit less. But over the last year, as you can see, the real wages have dropped significantly, really. In average, in the Eurozone, we are at minus 6.5%. So this is a huge decrease. And I mean, for you, it's important to know that because, for example, if you need to negotiate your salary, you need to take into account the inflation, because if your increase is lower than the inflation, well, it means that you're going to lose purchasing power. Now I'm going to give you some principles about inflation. First of all, inflation is going to decrease the value of your savings. Let me give you an example. So here I have an Excel file. So we have here an example with 2% inflation per year. So we start here at year 0. The price of the asset is 100. And every year we're going to add 2%. Okay. So there's a cumulative effect here. And finally, in the year 15, so we have 15 years, in the year 15, the price of the asset is reaching 135. Okay. So now you can take a look here at this column, the purchasing power. So we start obviously at 100%, and every year the value is decreasing a little bit. So it's just the price at the beginning divided by the price here in this column. And in the end, the purchasing power is down to 74%. So it means that there's a decrease of the purchasing power of 26%. So on this example, you can see that when you have over a period of 15 years, a 2% inflation in average, it means that the value of your money has decreased by 26%. That's what it means. So if you want to keep your purchasing power, your return on your investment needs to be higher than the inflation rate. So the next thing is the impact of inflation can be much harder on poor classes. Okay, why is that? Because in the poor classes, usually the people, they cannot afford, they don't have a lot of extra money. Usually they pay rent, food, and energy, but in addition to that, they don't have a lot of, spare capacity to increase their expenses. And so it can be very quickly difficult for them. So obviously, any government should, be careful and try to avoid this situation of very high inflation, especially when the salaries are not increasing at the same pace. And last thing, you need to understand that inflation is actually a hidden tax. So why is that? Because when there's inflation, the prices of goods, for example, are going to increase. And you have some taxes like VAT, for example, value-added taxes, which are a percentage of the goods, of the prices of the goods. So it means that inflation is going to increase the revenue from VAT for the government. But you have it's the same like, for example, in the salaries. If the salaries are increasing during an inflation period, then you have some taxes based on salaries, which are also a percentage. And this is going to increase also the revenues for the government. So over time, this can have a significant impact on the debt of the country. It can help the government decrease the debt compared to GDP significantly. And so that's why sometimes governments actually like some inflation. But for the other people, usually, well, it's not a good thing. The inflation is a very important indicator for all investors and especially all central bankers. So let me give you an example. Here we have the European Central Bank. So in the first line here, they say we work to keep prices stable in the euro area. So that's their main objective. Okay, so it's a very important indicator, but it's always difficult sometimes to analyze and to make forecasts. Why is that? Because when you're talking about a parameter of a very complex ecosystem, okay? The economic ecosystem, there's a lot of parameters who are interacting with each other. A lot of things can have an impact, you know, on the inflation. It can be the interest rates. It can be the GDP of some countries. It can be also conflicts. If you have a war between two countries, this can have obviously an impact on the logistics, and so plenty of things, you know, can have an impact on inflation. So let me give you an anecdote about that. Last year, you know, in the US, uh, and also during the beginning of this year, the Fed, the central bank, was always saying that inflation is transitory. Okay, they've been saying that for a long time, you know, during more than 6 months. And you know, in the end, when they saw that basically they were wrong, they made a mistake. Well, the president, you know, came out. It was in May or June this year. He came out and said that they were wrong, and that the inflation would stay high for a longer period. But he also said another thing, very interesting, I would say. He said, and I quote, "We understand better how little we understand about inflation." So this is a little bit crazy, you know, quote, because Jerome Powell, the president of the Fed, is supposed to be the guy in the world who understand, you know, better, who is the guy who understand better inflation, how, you know, inflation is created, what are the causes. But actually, here is said like 3 months ago that they don't understand it, and he has a whole team, you know, of PhDs working for him, but you know, they don't really understand how inflation is created. So I would say, to defend him, there's an explanation. The explanation is what I said before. This is a complex system, and when you're in a complex system, it's very difficult always to make forecasts. Okay, I think he could have, you know, seen it before, but that's what happened. Now, to give you my opinion about, you know, how inflation is created in the economic system, my position is very close to the position of the economist Milton Friedman. So Milton Friedman said, I will quote, "Inflation is always and everywhere a monetary phenomenon." Okay, so he's saying that everything is coming from the monetary policy. And it also argued that one could not find inflation anywhere in the world that was not caused by a prior increase in the supply of money or in the growth rate of the supply of money. Okay, so basically what it's saying here is that we have big inflation because of the central banks and the way they're creating money or increasing, have a policy which gonna increase too much the supply of money. Okay, according to him, if you're increasing too much the money, and if in front of that there's not the same value of extra goods and services, then you're gonna have some inflation. Okay, and I think I like him, Milton Friedman, because he's always trying, especially when you're talking about a complex ecosystem, he's always trying to simplify things. Okay, I think when you're talking about a complex system, you need to simplify things and try to identify, the key things which can have an impact on your economy. And I think that's what he did. Let me show you, for example, this is a money supply indicator, the MM3 in the United States. So we have a long period of time from the 1990 here. And so as you can see, it's growing up all the way every time, quicker. But the real change was here during COVID. And after that, as you can see, we have an enormous increase in these money supply indicators. Over the last 2-3 years, we have had a 40% increase in this supply indicator. So this is absolutely huge, much more than, much more than before. So I think obviously when you have so much extra money in the system, then one day or another, this money is gonna, diffuse in the system and finally impact the prices of all the goods and services, and so it's gonna increase your CPI. So now let's take a look at the figures of inflations. Today we are September 2027. First of all, in the United States, here you can see the inflation rate. So it's as you can see, it's pretty high over the last 12 months. So maybe we have seen a maximum here in June. It's not sure, 9.1%. It seems to go to slow down a little bit. So we'll see in the future. If we look at Europe, here you can see the euro area inflation rate. So over there, for the moment, we don't have any decline in the inflation rate. So it's still going up in August. We'll see afterwards, but for the moment, we don't have any decline. In terms of wages, so there's a difference between Europe and US. In the US, we have a big increase here in the wages, around 10% increase. So basically, it means that it compensates the inflation. But in Europe, as we've seen before, the real wages are declining actually. So that's the big difference between the two. If we look at commodities, here it's interesting because over the last 5 months we've seen a big decline in the commodities price. So maybe it's an indicator that in the future the prices are gonna go down because the prices of commodities can have an impact on the long term on prices of goods and services, because it diffuses in the economy. So maybe that's an indicator that the prices are gonna go down in the future. But for me, there's one main difference between Europe and the USA for the next months. It's the energy. Okay, I already talked about that in another video. I will put the link here. Euro in the euro area in Europe, they are very dependent on foreign energy, and on the contrary, obviously the US is producing a lot of energy themselves. So I think that Europe can, because of this, can be impacted more by inflation and during a longer period compared to the US. Now let's take a look at the central bank's policies over the last months. So first of all, the Fed in the US. So the Fed has started to increase interest rates in March this year. So very quickly, very strongly. So it has gone up to 3.25%. So this is a very strong increase. They're doing that to slow down the inflation. And then we have the same policy in Europe, the ECB, but it has started later, only in July, 4 months after that, after the US. So now it's at 1.25%. So as you can see, there's a big difference between the two zones. So 2% difference between the two zones. And that's one of the reason why the US dollar is so strong right now compared to the euro. So they're doing this to fight inflation. They have decided to increase strongly the interest rates, even if this can lead very quickly to a recession. But they're saying it clearly. They want to fight. That's their first objective. They want to fight inflation, even if this can lead to a recession. We don't know if it's gonna work because, as you know, inflation is much higher than that. And the real interest rates are still very negative in the US and also in Europe, especially in Europe. And some people like this guy Paul Volcker, who is a guy who was the president of the Fed in the 70s, and he fighted inflation, and he thinks that it's not possible to fight inflation when you have negative interest rates. So we'll see if it's working, but as you know, it's almost impossible for Europe, for example, to have positive interest rates, because they should increase, this number up to 9%, and this is, not sustainable because of the level of sovereign debt in Europe. So now let's take a look at which asset can help you to fight inflation in your portfolio. So we're gonna start by the stocks. So I like this graph because it shows you, the performance after inflation of different kinds of assets. As you see, in the long term, this is the stocks who are, providing after inflation the highest return. But this is not always true in the short term. So that's why sometimes you need to make some adjustments in your portfolio, or make some diversification. So just so that you can understand, the value of the stocks are usually based on discounted cash flows. So this is this formula. In order to evaluate the value, you need to have a discount rate. And basically, when the inflation is rising, to do this calculation, you need to increase your discount rate, because the value of your currency is decreasing. Okay, so it means that when there's an inflation rising, you can have some significant decrease of value in the stock market. But it's not true for all kinds of sectors. You can find some sectors in which there can be some good opportunities. Like, for example, and this is my opinion here, in the energy sector. So this is Chevron Corporation. This is a oil and gas stock in the US. So we're going to take a look at two periods when we had some inflation. Okay, so first of all, we have a first period here in the year 2008, and the inflation went up to almost 6%. So now if we could take a look at this graph, the price of the stock, you can see that exactly during this period when the inflation went up significantly, Well, at the same time, we had a very strong increase in the stock price for Chevron, and if we take a look at the other period recently, when where during which we had a big a rise of inflation, well. Again, we had here a very strong increase in the price of of Chevron. So on this example, it doesn't mean that it's going to work in the future, but on this example, as you can see, it's working very well. And now let's take a look at the valuations in the energy sector. So here you have a comparison between an index in oil and gas index, and actually it's a French index, this one, but it's a you can compare the two because the French index represents an average of the stocks. So as you can see, today we are the valuation of the oil and gas company are not very high. Okay, they're still, if you compare over the long term, they're still pretty low. We have some increase recently, but they are still very low. And also, I think there's some good opportunity in this sector because we currently have an energy crisis, especially in Europe. And I believe in the near future we will have some problem. Demand will be much higher than what we can offer, and so we may have some significant increase in the prices of oil and gas. Just to give you some example, here we have this study from the EIA, the Energy Authority in US, and as you can see, this is a graph from 2010 until the year 2050. So with some forecasts, as you can see, we have still in the next 20-30 years, we're gonna probably have an increase in the consumption of oil, gas, and also maybe coal. Even if we're gonna have a significant increase in the production of renewables energy, we won't be able to bring down the consumption of oil, gas, and coal. It's just not possible. Okay, there's not a new energy that can drive these consumptions down, and that's why I think there's going to be in the next years some very good opportunity in the oil and gas sector. Let me give you two sectors where I think it's too risky to invest right now. So, for example, here you have a company, Spera, who is producing aluminium in Europe. So here, it's a news. They're saying that they're gonna decrease by 50% their production because of energy prices. Because the production of aluminium, requires a lot of energy. So this is a big problem, especially in Europe. And then let's see another example here. So Yara, this is a producer of fertilizers. I already made a video about this. I will put the link here. So Yara here is saying that they have to decrease also their production by 35% because of energy prices. Fertilizer production requires a lot of natural gas, and actually the natural gas in Europe right now is extremely expensive. So that's why probably these kind of sectors are very risky right now, especially in Europe. On the contrary, sometimes you can find companies who are independent in terms of energy. I found this example. This is a gold mine in South Africa, Harmony Gold. Well, here they're saying that they are building their own solar power plant. Okay, so they're going to produce their own electricity, and this is a very, very good in this kind of period. This can be a very interesting investment when your company is independent in terms of energy. To sum up my position regarding the investment in stocks in a period where there's a lot of inflation, first of all, you need to have the ability to increase the prices. So this is much easier if, for example, you're in the energy sector or food sector, because everyone needs that. They need energy, absolutely, and they need food, so they will accept to pay higher prices. Secondly, it's better if you have a company with high fixed costs, or a company where there's been a lot of big investments, and for which you're going to be able to increase your production without investing more. So this is regarding the costs. So for me, in terms of sectors right now, the best ones are commodities, energy, agriculture, and food. So now let's talk about bonds. We are talking here about long-term bonds. So when there's inflation, it's not always very easy to find good opportunities in this sector, because when rates are going up, the value of the bonds are going to go down. So there's some products in the market that you can find. I'm going to show you here two ETF. Basically, inside there's some bonds for which the rates are based on the inflation. So if inflation is going up, well, the rates of these bonds are going to go up also. So it's government bonds mainly, so sovereign bonds. First of all, we have this ETF here. It's an Amundi ETF. As you can see, so it's a European fund. There's mainly bonds from France, also Italy, Spain, and Germany. As you can see, the maturity of the bonds are in average 7-8 years, something like that. So long-term bonds. And let's take a look at the evolution. Here you can take a look at 1 year evolution. So as you can see, well, it's not great. I mean, it's minus 7.3% approximately. Basically, it's going down, especially when there's a lot of inflation here in Europe. So it's not a great inflation edge. As you can see, it's not, I mean, other bonds are going down much more than that. So it's a little bit better, but it's not great. And we have also this example. This is a BlackRock fund, also based on bonds, sovereign bonds in euro. So it's the same type of fund. Clearly, as you can see, 8.6 years maturity, and we have mainly bonds issued by the French government and also Italy. And if you look at the chart, it's approximately the same, and it's also minus 7% over 1 year. So it's not. I don't believe it's a great opportunity when you invest in this fund. For me, especially because the underlying asset, it's not a very there's not a lot of quality in this asset, because it's a debt issued by a government, and the government always needs to raise more debt in order to be able to pay back these bonds. So I don't believe this is a good quality, good investment, and that's why I'm not buying these products. Now let's talk about gold. So personally, I think that you should have gold always in your portfolio, especially when there's an environment with inflation. You have to, when you think about gold, you have to think about an insurance. It's a kind of insurance that you need to have always in your portfolio. It's acting like an anti-fragile asset. which means that it's an asset which can go up a lot when there's a lot of tension on the market and when there's other parts of your portfolio which are going down or crashing. So it's gonna limit your losses, and also over a long period of time it's gonna maintain its purchasing power. Okay, so it's not gonna work always when there's inflation. For example, historically, if you look at the relation between the price of gold and the inflation, you can see that when the percentage of inflation is rising, then you're gonna have some good profits with your gold. But when even if the inflation is high, but it's going down, the percentage is going down. Well, in this case, it's not gonna do great, or sometimes it's going down a lot. So, I mean, it's not a perfect solution, but I believe you should have clearly some in your portfolio, especially when there's inflation. What should you do with your cash when there's inflation? So first of all, you need to choose your currency. So right now in the world, the currency which is the strongest against all other currency, it's the US dollars. So you can take a look at this index. It's called DXY. And basically, it's an index who is gonna show you the value of the US dollar compared to a basket of some other big currency in the world. And as you can see, over a long period of time, this is from 1985, we are reaching almost the maximum, okay, on this index. It's very high. It has increased a lot over the last months right now. So the dollar is really strong. It doesn't seem that it's gonna go down right now. So we don't know, of course, but it's very strong, as you can see, against some currency, like against the euro. It has been very, very strong over the last months. There's been a 20% change over the last year against the euro, so it's huge. So personally, I believe that that's the safest currency right now, the US dollar. It's the reference currency in the world. So you can leave it in cash, but you can also get some interest on your cash with very short-term bonds. Usually, if you invest in a fund, the fund is called government money market fund. So this is an example here. This is a fund from Fidelity, but they are all called, I mean, the name is always the same, government money market fund. But there's also some, other possibilities. I have found out that there's some bonds that you can buy directly with the treasury. Okay, so this is the website treasurydirect.gov, and actually there's some kind of specific bonds. You can buy many things: bills, notes, bonds, and this one is very special because it's called Series I savings bonds. And actually, right now, the interest rate on this one, it's 9.6%. Okay, this is the annual rate. It's very, very high, almost more than the inflation right now. The maximum investment is $10,000 per person. You gotta be a US person, and you gotta leave, I believe, the money during 12 months. So I think it's a pretty good idea. I don't believe there's going to be a default in the next 12 months. So yeah, I believe that's a good idea to invest your cash. So I'm gonna finish with Bitcoin, of course. So can Bitcoin help you fight against inflation? So let's be clear, for the moment, we don't know. We don't have a lot of history with Bitcoin. We have only 13 years, since the beginning. So we don't know exactly. What we know is that it's still there's a lot of volatility, as you can see here on this graph. So it's still very risky. You can lose a lot of money, maybe everything. So that's the reality. But on the other hand, I like Bitcoin because you cannot have any debasement, meaning that there's going to be 21 million Bitcoin in total. There's not going to be any more than that. So this is very different from the traditional currency, government currency, where for which you can have a lot of money printing. You can have a big increase in money supply, which creates afterwards some inflation. So that's what I like about Bitcoin, and that's why, yeah, I believe a little bit of Bitcoin in your portfolio is not a bad idea. Thanks for watching. If you like my videos, please subscribe, like, make some comments. This is really helping me to develop this channel. Thank you and see you soon. Bye bye.